Stocks have turned around to the downside. 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today. Bloomberg Open Interest starts right now.
Coming up, stocks are on course for their best week of the year, but a weak reading on the housing market is derailing the rally. Also, caution from Austin Goolsbee, the Chicago Fed president, says the labor market and some leading indicators on the economy are flashing warning signs. Amid all of this, the yen carry trade is staging a comeback. ATFX has seen a 30 to 40% rise in yen shorts in the past week. Let's take a look at where markets are trading at the moment. In terms of futures right now, we do see down arrows. That turnaround happened after we got the housing starts number and building permits, both disappointing compared to the expectation. We see S&P futures down 0.5%, NASDAQ futures off 0.5% as well. And investors are pushing down the yield on the 2-year, still above 4% at 4.03, 4.04. Katie?
NVIDIA shares this week jumping double digits, flirting with the biggest weekly advance since May of last year. That certainly helped to lift up the broader index altogether, Matt.
All right, let's take a look at what's going on in terms of the economic statistics this morning. We got on EcoGo on your Bloomberg terminal. Look at housing starts, a little bit disappointing. Building permits, a little bit disappointing as well. And maybe the problem is that this feeds negatively into the economy in terms of investment. A little bit later, in just about an hour's time, we're going to get University of Michigan consumer sentiment, and the inflation expectations. Will be paying close attention to that, and so will our first guest. Invesco Chief Global Market Strategist Kristina Hooper joins us here on set. Kristina, great to have you here. These markets are reacting in, I think, maybe an oversized way to each of these data points. It's not normal that housing starts would turn us around from 0.5% gains to 0.5% losses in futures, and yet today that's what we see.
Well, absolutely. And I think part of the problem is that we now see risks balanced, or in my opinion, I think the recession risk is higher than any kind of risk that we have a resurgence in inflation. And so as a result, markets aren't exactly sure how to react to data points. It was a lot easier to say bad news is good news. Now, bad news, we're not sure what it is. And I think that's part of the problem and adding to the volatility. But for me, I am focused on inflation expectations this morning, because I think it's an important part of the Fed's calculus. We want to make sure there are no obstacles in the Fed's way. There's nothing they can point to when they meet in September, because they need to cut rates.
They need to cut. Is 25 basis points going to be enough? Because that seems to be consensus. I know for a short couple of days, people kind of were freaking out, but now everyone has come back down to that a little bit more, maybe in terms of what we're seeing the market price in, but economists are pretty certain about that. What's your view?
I think 25 basis points is enough to start, and it would be very appropriate for the Fed. Thinking about 2022, when they went to tighten, even though they were behind the curve, they started with 25 basis points. They quickly accelerated, but I think to save face, they started with 25, and I think they would follow a similar tack this time and start with 25, and if necessary, cut more in the following meetings.
Can we actually back up? Why do they need to cut rates? I mean, as Matt mentioned, we heard from Austin Goolsbee this morning saying that he's starting to get a little bit worried about the economy, about the labor market. Do you share that view?
I do. I think we're starting to see cracks form. It's largely among lower income households, but it is significant, and I think it is likely to spread. So every day we have monetary policy as restrictive as we have it today increases our recession risks. I think there's no other way to look at this. I don't think we have to worry about some kind of resurgence in inflation. I think that's very unlikely. I know the Fed is reluctant. Jay Powell doesn't want to be another Arthur Burns, but the reality is that he needs to be far more focused on recessionary risks.
And so wrap this into how you position a portfolio around this. This is a Fed that needs to cut rates. Every meeting that they don't, the risk of recession increases. I mean, do you start hedging for that recession possibility, or do you really have faith here that the Fed will deliver?
I think you hedge for that recession possibility, but I have to say it is not my base case. And so my positioning would be focused on smaller caps, cyclicals, an assumption that markets will discount an economic reacceleration at some point late this year, early next. But that's the purpose of diversification, is to hedge your bets, right? And so I think there needs to be exposure to defensives. Within a fixed income portfolio, it's important to have exposure to a variety of different sleeves, from municipals to investment grade to higher quality, high yield. All of those can play an important role. Some will work better in some economic scenarios than others, but I think it's carving together a portfolio that has a lot of diversification in an environment where uncertainty is rising is really important.
I have a viewer who's writing in with a question. How are you advising clients to invest over the next 4 months in terms of sector changes, allocation into other asset classes, maybe taking some gains off the table?
I think the very tactical view, 1 month ahead, would be more defensive. I think we're seeing a fair amount of volatility. We've got a relative strength indicator that has bounced back from 30 to close to 60 on the S&P 500. So I think in the very, very short term, defensive makes more sense. But I think opportunities are going to present themselves, especially if we see more volatility, especially if we see more sell-offs. And that has a lot of potential to offer openings for those who are significantly overweight cash. And there are many portfolios where there's a very significant overweight to cash. This fall might be present a lot of entry opportunities.
And let's talk about some of the known unknowns when it comes to positioning and some of the technicals. And I'm talking about the yen carry trade. Of course, that unwind certainly spooked markets over the past couple of weeks. One of the most read stories on the terminal right now is about how that carry trade attracting hedge funds again. How worried are you? Do you think that we're past the bulk of the digestion there, or is there still more to go?
Well, I certainly think that the future holds a stronger yen and a weaker dollar. Now, there are going to be some phases in this process, especially as we wait for the next moves by both central banks. So temporarily, I think there is that moving back into the trade. But I think ultimately it doesn't look attractive.
Kristina, I mean, we've been debating about this. How deep do you dive into it? You're like an education junkie. I mean, you have a JD and an MA, and you're a certified, I'm looking at your CV, certified financial planner, certified alternative investment analyst, certified investment management analyst, certified financial consultant. I mean, how deep do you dive into this kind of opaque world of carry trades and try and gauge whether it's 75% unwound or whether it's coming back by 30 to 40%? I mean, how much does it matter?
I actually don't think it matters too much. I think we have to recognize that it presents the potential to create more volatility. Look what it did just recently. And so I think we have to recognize that this could happen again. I think it's hard to have that precision. There's a false precision in setting exact targets and coming up with specific numbers for something like this, as well as even targets for the S&P 500. I think it's much more appropriate to get it right directionally, to understand what the threat might be and what it might do.
So really quickly, just to sort of tie a bow on this, I mean, if we do see more of that volatility, given there's debate as to how much it actually matters, does it actually affect fundamentals, would those be buying opportunities if you saw it, take down NVIDIA by 7% again?
Well, I certainly think triggering a sell-off presents buying opportunities, especially in an environment in which we have the Fed poised to start cutting. And I think, especially once they start cutting, we're in an environment that's much more, I think, supportive of risk assets. So it could very well present a buying opportunity. For individual stocks, it's harder to say, but I think in general, there's going to be some sell-offs in our near future. And that is likely to be a buying opportunity.
All right, Kristina, it's always great to see you. Really appreciate you taking the time on a Friday morning. That, of course, is Invesco Chief Global Market Strategist Kristina Hooper. And we do want to bring you some breaking news right now. This out of the political realm. Howard Lutnick named a Trump transition team co-chair. Of course, in the event that Donald Trump does win the presidency again, Linda McMahon also named to that transition team as a co-chair there. We're going to continue to follow that story, bring you more details as we have them. But it's a busy day in the markets right now. Let's get a check on futures. The S&P 500 currently lower by a hair in the pre-market, down about 0.4%. A little bit more if you take a look at the NASDAQ 100. Same thing, too, at the Russell 2000, those small caps. Of course, we had disappointing housing starts. That seems to be taking some of the momentum out of the enthusiasm that we've seen at the index level this week. But let's take a look under the hood now. We're going to do that with Abigail Doolittle.
Well, starting off with one stock that is dragging, Katie, the shares of Bumble right now down 3.7%. This as Cowen has cut the shares to a hold from a buy on the company's uncertain recovery path per their research. They say that the near-term opportunity is unclear given the gradually worsening paying trends plus industry headwinds. Into today, the stock already down about 60% on the year, so clearly in a world of hurt, and there is a 13% bearish short interest, so those bears really winning. Turning to a stock that's doing a little bit better, though, quite a bit better actually. Planet Labs up 9.3%. They are putting their first hyperspectral satellite Tanager 1 into space, along with 36 Super Doves. They will launch on the Transporter 11 rideshare mission with SpaceX and expand by 400 spectral bands of data. And then finally, Lumen, these shares lower by a significant amount, almost more than 4% here. Wells Fargo has cut the stock on their weakening legacy revenue. They are saying that the private connectivity is a better reward, but in terms of that legacy, Matt, it creates an overall less favorable risk to reward ratio.
All right, very interesting stuff. Abigail Doolittle, thanks very much. Coming up, we're watching Rivian as the EV maker pauses production of those Amazon delivery vans due to a supply chain issue. We'll talk tech with Ed Ludlow next. This is Bloomberg. Let's get now to high interest to look at what's making headlines around the world. VP Kamala Harris is set to propose sweeping new federal subsidies for lower-income Americans, parents, and home buyers, alongside new programs to curb increases in rent and grocery prices. Her plan includes expanding the child tax credit to $3,600 from $2,000 per dependent, with a supersized $6,000 credit for newborn babies. Meanwhile, Donald Trump is trying to reset his campaign as he loses ground in the polls. Corey Lewandowski and Dan Murtaugh are back from his 2016 and 2020 campaigns, respectively. And breaking just moments ago, Howard Lutnick has been named Trump's transition team co-chair, along with former World Wrestling executive Linda McMahon. The two will chair his transition into the White House should he win. Meanwhile, back in the world of business, Texas Instruments is set to receive a $1.6 billion grant in the CHIPS Act grants and $3 billion in loans as well. The announcement came from the Biden administration and will help the company pay for one factory in Utah and two in Texas, with 2,000 more manufacturing jobs expected as a result, if it actually gets built. Katie?
And sticking with chips, Applied Materials, which is the largest U.S. maker of chip manufacturing equipment, it delivered an in-line sales forecast for the fiscal fourth quarter. But investors clearly were looking for a bigger payoff from AI spending. Bloomberg Technology co-host Ed Ludlow joins us now with shares down about 3% pre-market, Ed. And of course, when we're talking about Applied Materials, they're a key supplier to Taiwan Semiconductor, Samsung, yes, Intel. And I guess those companies just weren't spending as much money as maybe investors hoped.
Yeah, it's not that Applied Materials did anything wrong. You know, in the third quarter, it was pretty decent, and beat on most metrics. But the street has very high expectations that all of the capital expenditures going into infrastructure right now, particularly relating to AI, is going to have ripple effects for everyone. Applied Materials is not at the sort of lead cutting edge of machines that make those top-end AI accelerators. That's ASML. But there are lots of other ways that it could be involved. For example, when we see high-bandwidth memory kick off from Samsung, SK Hynix, and Micron, they provide machines for that. So the guidance was fine. It's just that at the high end of the range, people thought it would be a lot better than it was. And it just shows there's probably a while to go until this massive boom happens, or indeed that it's continuing at the pace we expect.
It's pretty amazing that they're not getting enough orders for the automotive business when, Ed, auto sales haven't slowed down, and you know that the number of chips needed in every car just continues to climb to eye-popping amounts.
This is the data to track for the bigger picture. We don't have crystal balls, but it's as close as you can get to it, looking at the chip equipment makers. Because if you look at Applied Materials commentary and results, it's consistent with what NXP told us, that more cyclical industries, like the companies that make chips for cars, are sort of giving off sluggish demand vibes. And that's very interesting because you're completely right. The number of control units in any given EV is a lot. But at the end of the day, it's a sort of confidence thing. And it tells us that in the end market for automotive chips, they're probably not as bullish or in a full investment mode as perhaps we thought they might be at this stage of the cycle.
And Ed, switching gears here, you're not just an anchor. You also write stories as well, and you break news.
Sometimes.
And you broke some news last night when it comes to Rivian. This is interesting. Pausing production of the EV commercial van that it makes for Amazon. What's going on there?
Yeah, there's some sort of part shortage, which happened at the beginning of August, immediately following the quarterly earnings that they just reported. I don't know which part it is, but essentially, they've just stopped the line until it comes in. It's an example of the kind of disruption that Rivian continues to have to deal with. Importantly, there's no sort of material impact to guidance, right? The line in Normal, Illinois is capable of building about 15,000 of those things you see on your screen. They have a surplus of them anyway. If you fly to Chicago and you drive the 2 hours to Normal and you get to Rivian's factory, you'd see hundreds of them on the concrete outside because Amazon's been pretty chill about taking delivery of them, frankly. And what's interesting is that in the final 3 months of the year, Amazon's busiest period, they actually hold off taking delivery of new vans and expanding their fleets because they're just too busy dealing with holiday traffic and packages. So it's like teething problems, but I want to know more about what's going on. And I think investors set a really high bar for Rivian because of all the names on the cap table, the holders, the amount of cash they're burning through. And it just shows they're not immune to what's going on around the world.
Well, much more coverage coming up on Bloomberg Technology with Ed Ludlow a little bit later on. Appreciate your reporting as always. More scoops. Rivian currently down about 1% pre-market. Now coming up, we'll take a look at the companies making the most social buzz today in our Social Climber segment. Up next. This is Bloomberg. All right, it's time now for Social Climbers. The company's making waves this morning. And first up, H&R Block reporting a strong fourth quarter that beat Wall Street estimates. The tax prep company also guiding for another year of revenue growth. Shares flying right now, currently up almost 10% pre-market. Next up, Bank of America is adding to its list of sports sponsorships with a deal for the FIFA World Cup. Bank of America will be the first banking partner for the event in 2026, and the bank plans to have a physical presence across the host cities to tap new and existing clients. And finally, AST Space Mobile is confirming an early September window for its inaugural commercial satellite launch. The telecom company says that the satellites will be the largest ever to be deployed commercially in low Earth orbit. And of course, you can follow all the latest company buzz on TREN Go on your Bloomberg terminal, Matt.
All right. Take a look at what's going on in the markets right now. We had futures up just about an hour ago. Then we got housing starts out. That data disappointed, as well as building permits. And as a result, we are now pointed down just about 7 minutes into the open. One of the other big deals in markets, definitely the last couple of weeks, but it seems to be re-emerging, is the carry trade. And I want to talk to Damian Sassower about that. He's Bloomberg Intelligence Chief Emerging Markets Credit Strategist. And I thought of you, Damian, as I was reading about all these EM currencies that are swirling around. Like, the carry trade is an abstruse thing. We can't really put our fingers on it or wrap our hands around it. You can't really measure it. But Nomura was out today saying that it's back on right now as borrowing in the yen is being traded into higher yielding currencies. What's your take?
Well, you really can't measure it, but of course I try to, right? So let's talk about the debt of Japan. And we're not talking about the $4 trillion in Bank of Japan debt. We're talking about $20 trillion if you include GPIF, the biggest pension fund, and all the state-owned banks. And let me tell you something, all of them are positioned outside of the country in non-dollar assets. So what you're talking about is that repatriation of yen back on shore. And what that did is it caused this massive unwind. Traders were caught the wrong way, et cetera. But look how quickly it's come all the way back. And it's not just the yen carry trade. It's all leverage positions for that matter, Matt. It's, payers in the U.S., in the U.S. Treasury market, steepeners, flatteners, all of the curve trades. A lot of that came off. A lot of that's coming back on. You've got the VIX now down below 16. And what I'm finally seeing in terms of currencies, not just in developed and emerging markets, are finally paying attention to monetary policy. So we've had 19 major emerging and developed market central banks, announce on rates over the better part of the last month. 9 of them have cut. So now what you're seeing is those who really can't afford to keep interest rates this high are basically cutting rates ahead of the Fed, and their currencies are taking a hit for them.
Another good word for the carry trade, I think, is nebulous.
Yes.
Another good word. That was the word.
Yes, that's the word you used, and I thought that's a great way to describe the carry. Thank you, Kate.
I got a lot of words, but we were talking about this with Kristina Hooper, and she said, zooming out, the path of the yen is stronger versus the dollar. You think about that divergence that you're talking about between EM and DM. You think about just the Bank of Japan versus the Fed. Those two are diverging.
Right. Well, I think what you have to do is you have to decompose exactly what generates a total return in a carry trade. Well, there's 2 components of it. There's movements in the spot FX rate, which is what we're seeing and what we're talking about with yen now back below 150 and approaching 140. I don't even know where it is today. And the interest rate component. And let me talk about that interest rate component for 1 minute, because let me tell you something. Yields in Turkey are 50% overnight. Yields in Brazil are 10.5%, and they're over 10% in Mexico. So, when you talk about, the carry component, the interest rate return on these carry trades, it's significant because of these yield differentials, and that's not going away anytime soon. So I think what we're seeing is a reversal. People are putting back on the carry trades if you listen to them more and some of these others, and I expect that to continue.
Just got about 45 seconds left, Damian. We got a viewer writing in and asking, if the Fed cuts rates, does that force the hand, I guess, further of the other global central banks that you're watching?
Well, at least they're not asking about my jacket. I'm on radio today. But let me just talk about this. If you're talking about really Fed movement and what that means for the rest of the world follows the Fed. Some of these central banks are trying to get ahead of it, which is what we're seeing over the better part of, the last week. New Zealand, the Philippines this week. Next week, we're going to see Sweden probably cut rates again ahead of the Fed. But really, at the end of the day, it's other countries who started cutting, like Brazil, who are now pausing. Other countries like Mexico who are not moving as quickly as we otherwise have thought. And again, these are countries whose policy rates, their overnight rates, are over 10%. So, on a relative basis, you've still got 500 plus basis points of carry cushion that's going to save the day.
I know you're on radio and YouTube with Tom Keene right now doing surveillance. I know you're with Tom because you quoted the VIX. And he's never had a Walter's hot dog. Did you know that? I heard this morning. I was listening to you guys on the way in. Tom has never had a Walter's hot dog.
I don't know what that is.
The greatest hot dog in America.
You split it. They cook it in butter. It's delicious.
Made in Mamaroneck.
Oh, it's great
Celebrating
stuff.
their, I think, 105th year anniversary. Just delicious.
Is that fat-free?
Damian Sassower, thanks very much. It's fat full. All right, more on these falling markets coming up. We're going to talk to Linda Duessel when we come back. This is Bloomberg. We are moments away from the start of the cash trade. This is Bloomberg Open Interest. I'm Matt Miller. We saw a real turnaround in futures this morning. We were headed up. We're still on track for a weekly gain, big weekly gain, but we do see futures now lower. S&P futures off about 1/3%, a little more. NASDAQ futures also off about that much. There you hear the opening bells on the New York Stock Exchange. You've got what looks like Q2 ringing the opening bell. And on the NASDAQ, Smokey the Bear, 80th birthday. That's excellent. He's quite young, actually. I would have imagined he was older. Only you can prevent forest fires. Let's get a quick check on the major averages this morning as we kick off the session here. S&P 500 down about 0.25% right now. NASDAQ 100, so the bigger tech stocks down 0.5%. The small caps on the Russell 2000 down a little bit less than 0.25%. One of the stocks that we're watching at the open is H&R Block. Earnings there beat estimates in the fiscal fourth quarter. H&R Block announced a $1.5 billion share buyback, as well as a 17% dividend increase. So giving money, returning cash to shareholders, that's what the market likes to see. There you can see the full quote. Let's get over to Katie Greifeld right now. Katie, what are you watching?
Yeah, not as rosy if you take a look at Applied Materials. We were just talking about this with Ed Ludlow. Of course, the chipmaker sales forecast, it came in line with estimates. That's good news, but the bar was really high. Shareholders clearly looking for bigger returns on the AI investment. Shares currently off about 4% just a couple seconds into the cash trade. We also want to take a look at NVIDIA's week because the stock rose by more than 12%, of course, lifting the S&P 500, lifting the NASDAQ, also bringing the company's market value above the $3 trillion mark. Let's take a closer look now with Bloomberg's Abigail Doolittle.
Yeah, lots of rally action this week, Katie, for big tech and the markets overall right now. Yesterday, actually, I should say, we had these indexes up 6 days in a row. But take a look at tech on the week. Super Microcomputer gaining 22%, basically in a bull market after having dropped in a bear market. Nvidia, I don't know whether or not it's still in a bear market. I suspect it's not. But the degree of the bear market, probably this stock may still be in a correction from its peak. We'll be taking a look at that chart in the 10 o'clock hour. Micron up 14%, Broadcom. So you see this broad rebound for the chip space as investors are buying the dip from that big sell-off induced in part by too far, too fast, the yen carry trade. Let's take a look at technology relative to the other sectors, because we are going to see this massive outperformance, up 8%, the best week since 2022. Discretionary, there's also some big tech in there. Financials, healthcare, and then you can see that the more dividend-oriented, rates-oriented sectors on bottom. Real estate and utilities not even up 1%. So big outperformance for tech. One question, though, is will it last? There are some similarities to the monthly chart of the NASDAQ 100 to 2022 out of the 2020 pandemic low. You can see this big rally. The RSI overbought for a period of time, but then it started to cross it lower. It didn't happen all in one stroke in 2022. It took some time. Well, take a look at this massive rally that we've had for the NASDAQ 100. Interestingly, similar to into 2022, the trend reversing. The point of a trend line is not to see the trend, it's to see when it reverses. The RSI starting to come out of overbought. It suggests at some point, Matt, that the big tech strength that we've had this week, well, that may not be the case.
It's amazing how overbought it was, though, Abigail, in 2022. And we were talking this morning with Kristina Hooper of Invesco. She mentioned the RSI as well. We're not quite there yet, right, where we were in that last big rally.
Yeah, we're not there, and it's unlikely that we will be. So that was truly overbought, to your point, between in June of 2021 into 2022. Right now, we were right above 70, now at 69, which really points to the uncertainty. Not quite as robust here, but still a pretty tremendous rally. Last year, the first half for the NASDAQ 100 up 40%. That was the best first half for the NASDAQ 100 ever. So lots of steam rising there, and now it seems to be evaporating a little bit. It's going to be interesting to see whether or not we have something similar to what did happen in 2022.
All right, we'll definitely keep our eye on it. Abby, thanks so much. Abigail Doolittle taking you through the technicals. Let's bring in Linda Duessel right now, Senior Equity Strategist at Federated Hermes. Linda, we've seen an incredible bounce back from the Manic Monday that we had last week. What are you doing right now? I mean, I think a lot of people used that drop to get back into tech stocks that they'd sold off. At least the 13F showed us that a lot of big hedge funds had taken some profits. Where are you positioned?
Well, good morning. Thanks for having me. The VIX that spiked was a kind of a rare spike. It was an extremely rare decline from that spike. And history suggests that when the VIX goes spikes like that, you should expect some more tremors before you think you're out of the woods. So we're suggesting still that, you know, even though it's all over the map as to whether this carry trade is over, your commentary about what's going on in the technology sector is very interesting. And like it seems like every quarter we need to bite our nails as we wait and see what NVIDIA tells us in terms of their earnings and their outlook. And that can also just on its own be a time to pull back yet again. So we think we're still going to have some volatile months now.
Yeah, NVIDIA doesn't report until August 28th after market. That certainly will be a lot of fun. But let's go back to the carry trade, the nebulous carry trade that we've been talking about. It's extremely technical in nature. It's not going to alter the fundamentals of an NVIDIA, for example. And Linda, with that in mind, if we do see more volatility around the carry trade, fears of that unwind, is that a time to really buy that dip?
Well, you know, again, the numbers as to how far we are through the unwind of this carry trade are all over the map. So it's hard to really suggest that that bit of it is done. It's probably largely done, but because these names, these technology names are so widely owned all around the world, it's hard to believe that, you know, one couple of day trade is you're done. It's really hard to believe that. And it seems impossible for the experts to really pin down whether it is, which is why I bring up earnings season anyway. Regardless whether people bought on the dip or not, people still heavily invested in the large caps tech sector, which we like, and we like the broadening of the market. We're simply suggesting that more volatility is likely to come as people are on edge. Traders are on edge. It's the summertime trading environment and the like.
How confident are you? I mean, this earnings season has been very strong, 11, 12, 13% growth in terms of profits, and the rest of the S&P, after you take out the mega cap stocks, which has been in an earnings recession for the last 6 quarters, is finally turning a profit. Do you expect that broadening to continue in the second half?
Well, yeah, it's very, very interesting. The broadening is such a great thing to see because it gives you more confidence that it's not just a handful of names. And indeed, it's been a much stronger second quarter than many thought. We've suggested that we're going to watch profit margins and see what the guidance is. So the guidance that came out of the second quarter, you saw a more broadening of companies reducing their guidance. You see a more broadening of companies raising their profit margins. 2/3 of the companies had profit margins up in the second quarter, which is great news. But you've seen for third quarter earnings per share expectations brought a broadening of bringing that down. So it could be kind of a pivot moment potentially, or at least let's not get too excited to continue to extrapolate. It's just one of those things. It's much like the jobs market. Are we having a problem or not in the jobs market? Are we having a problem or not in the retail sales environment? It just, things are staying stronger for longer, but we're all just biting our nails for the flip over, and third quarter will be interesting.
Mm-hmm. Yeah, well, that's where I wanted to go. And you talk about this nail bite moment. I wonder if we're seeing the high water mark, because already you're starting to see some Q3 estimates come down for earnings, depending on which measure you look at.
Yes, indeed. Depending on what number you look at, the earnings figures for the second quarter were 11, 12%, and that's being brought down to 6%, maybe when all is said and done, maybe 8%, but a decrease to be sure. So we are expecting that more of this concern will start to eke its way out into the into the various parts of our economy and our markets. But still, we think, look, we have a 55-20 figure for this year end in the S&P, and that's where we're at right now. That argues for continued volatility on the downside, strength after the election, and we have a 6,000 target for next year. So a broadening of a slowing but still no recession is kind of our bottom line.
All right, Linda, that's a good place to leave it. Really appreciate you taking the time. That is Linda Duessel. She is Federated Hermes Senior Equity Strategist. Have a great weekend. Now, coming up, with Mpox being declared a health emergency, we speak to Dr. Seth Lederman. He is the CEO of Tonix Pharmaceuticals, which has a vaccine candidate for the virus. That conversation coming up next. This is Bloomberg.
All right, let's take a look at what's going on in the market right now. Just about 13 minutes into the trade, we are still down only about 0.1% on the S&P 500. We had been up this morning, and then housing starts came out in a disappointing way, building permits as well, and as a result, we turned around. The NASDAQ 100, the big cap tech stocks, are lower right now, and the Russell 2000 is gaining. So a little bit of a rotation this morning, Katie.
A tiny rotation. We'll see if it can build a little bit, but it's time now for our top calls. Some of the analyst action in focus this morning, and first up, Wells Fargo going all in on Fox with a double upgrade from sell to buy. The analyst attributing his bullish call to the company's sports streaming opportunities. Next up, Bank of America says that Estee Lauder no longer a buy. The firm downgrading the beauty giant and cutting its price target by $40. The analyst cites weaker than expected performance in China. And finally, TD Cowen cautioning investors on Bumble as it cuts its buy rating on the online dating site. The analyst cites an uncertain path to recovery thanks to fewer users, the lack of other portfolio brands, and broader challenges in the online dating space, Matt.
All right, let's get to an issue that has been popping up on the most read for the last few days, and that is Mpox. The World Health Organization has declared the fast-spreading Mpox outbreak in Africa a global health emergency, and now as the variant changes, it leads to more challenges trying to contain it. The Director General spoke about his concerns.
WHO has been working on the Mpox outbreak in Africa and raising the alarm that this is something that should concern us all. The emergency committee met and advised me that, in its view, the situation constitutes a public health emergency of international concern.
Joining us now is Dr. Seth Lederman, CEO of Tonix Pharmaceuticals, which has a vaccine in development for the virus. Doctor, really appreciate your time this morning. Tell us about this vaccine. I believe it's not in human testing yet. So is it likely that you get it through testing and out in time, I should say, to contain this virus?
Yes. First of all, thank you for having me on. We've done advanced animal testing, and we're ready to start manufacturing. And we are glad that WHO has declared Mpox a global health emergency of international concern. Our vaccine at Tonix is a live virus vaccine, and that allows us to vaccinate potentially many more people at a lower cost. And we think it has the capability of making an impact on public health.
And how long do you see the threat of Mpox remaining? And I mean, extrapolating that out, how big do you think the market could potentially become here?
Well, it's frightening to think about it, but 2 years ago was the most recent public health emergency involving Mpox. And in that, 32,000 Americans have become infected, and it's now endemic in the United States. But this new strain, Clade 1b, which, by the way, was first detected outside of Africa in Sweden yesterday, is expected to come to the United States. This is believed to be more contagious than the Clade 2 that infected 32,000 Americans in the past 2 years, and also approximately 20 times more lethal.
I remember when we were at the start of the COVID outbreak, and Angela Merkel, the chancellor of Germany at the time, said she thought 60 to 70% of the population could get it, and that sounded insane. Of course, now we've all gotten it. Can Mpox get this bad?
Well, we're still learning about the transmissibility of this Clade 1b variant, but it does seem to be more transmissible than the Clade 2 variant. In the United States, the Clade 2 variant was mostly restricted to men who have sex with men. But in Africa, monkeypox, about 50% of the deaths are in children. So this is not technically a venereal disease, but it is transmitted by contact and also potentially by aerosol. So I can't guess right now how widespread it will become in the United States, but it is hard to imagine that it won't spread in the United States. And in fact, we really don't know. The HHS said yesterday they don't believe that Clade 1b is in the United States yet, but we did, as far as I know, the CDC is not actively testing.
And I want to talk a little bit more about your specific vaccine and the trial that's underway. What type of trial is this, and when might we expect results to be published?
Right. So we haven't started a trial yet. Now we're reinvigorating our efforts because, frankly, interest in Mpox was maintained at Tonix, but not by health authorities or investors. So we're ready to jump on and get going again. But the difference is that ours is a live virus vaccine. It's a modern form. We call it a fourth generation, similar to the vaccine that Edward Jenner introduced in 1800, but we believe with much better tolerability profile, much better, 10,000-fold in animals. And this, when Jenner's vaccine was used to prevent smallpox all over the world, that actually kept Mpox out of the human population. So we think from a public health point of view, a live virus vaccine has the ability to block forward transmission and to be work with only one dose. And that's a big advantage, both in the United States and other countries.
Well, Doctor, we'll definitely keep an eye out for that trial start. Really appreciate you taking the time today to walk us through it. That, of course, is Tonix CEO Dr. Seth Lederman. Now coming up, best known for buy now, pay later loans, the fintech firm Klarna eyeing an IPO. More details next in our Wall Street Beat. This is Bloomberg.
This is Bloomberg Open Interest. I'm Matt Miller. Let's get a quick check on where stocks are trading at the moment. Right now, the S&P 500 getting towards little change, getting towards unch. We had been up about 0.5% on futures, then down 0.5% after the housing starts came out, and now we're looking very little change here, but still up bigly for the week. The NASDAQ 100 down about 0.3%, the Russell 2000 gaining. The S&P has been on quite a tear this week since it had such a disappointing Monday last week. Then it was unchanged at the end of the week. Right now we're up 3.6% for the week.
And we do have, of course, some data coming at the top of the hour. University of Michigan sentiment coming out. Of course, we're moving on every single data point right now. It'll be interesting to see what happens. But it's time now for our Wall Street beat. Swedish fintech Klarna is setting the stage to be one of the biggest U.S. IPOs of 2025. The CEO joined Bloomberg earlier this morning about the company's future.
We're probably going to hit over $1 billion in revenue in the U.S. pretty soon. So, and that has obviously made sure that we are doubling down our efforts to accelerate rolling out new services in the U.S. as well. But especially when you talk about things like bank license, it does take some time, right? They took us a few years to get our European banking license, so we don't want to make the dependency on the IPO to that.
And for more on Klarna's growth and their plans, I'm thrilled to say we're joined now by Bloomberg's Bailey Lipschultz, who covers IPOs and everything else. And Bailey, you're on set on a Friday, which is a treat in and of itself.
You're in the office on a Friday.
Well, I'm co-hosting Bloomberg Radio from 10 to noon, so if you get bored of this,
with Alex Steele?
With Alex Steele, yeah.
Oh, you're a lucky guy. Well, you have about 7 minutes, 6.5 minutes here. Tell us a little bit about Klarna and their plans. Does 2025 sound realistic?
I mean, it could be. When I talk to bankers, though, 2025 is kind of being chalked up to a lost year in the sense that you're coming out of the August lull. If you want to go public, you have to do it after Labor Day. You're really kind of threading the needle between that and the U.S. election. Do you want to go right before Thanksgiving, or do you want to try to, again, Thanksgiving this year is on November 28th, so when you look at the calendar, it's pretty choppy. So the bulk of activity when I talk to bankers and executives and investors is likely going to happen in the March to May timeframe next year.
So it's less likely, in your opinion, that they actually go in 2025, but they'll be big, right?
They're big.
I imagine if it's one of the biggest U.S. IPOs, that means it's going to be one of the biggest global IPOs.
It would be. We don't know what the logic or thinking could be, but right now we're seeing, in Bloomberg's reported, Klarna could target a valuation of $20 billion. So if you kind of slice and dice how many shares they offer and kind of what they want that float to be, that'll be interesting. But when you got to look at this company, you got to keep in mind, they did a funding round in 2022 at $6.7 billion. That was a sharp drop from $45.6 billion. So what this logic looks like, what the thinking looks like, what the messaging from the company and from bankers, kind of how that plays out when you, at least from a public investing standpoint, your best comp is a firm, which is down more than 80% from its 2021 peak.
So we're going to continue to keep an eye on Klarna here, but let's talk a little bit more about the end of this year. Like you said, a lot of difficult needles to thread there between, all the holidays, the election, et cetera, et cetera. Is anyone else notable expected in the pipeline for the rest of this year?
We've reported names, the likes of a StubHub, the likes of an Ingram Micro. It's going to be interesting to see kind of what the receptivity is of investors when we get closer to potentially launching those IPOs, but it really feels like the others, the insurance names, the healthcare names, that's really what's going to make up the bulk of the post-Labor Day window.
All right. Bailey, thanks very much for joining us. Look forward to your radio show from 10 to 12 on Bloomberg Radio with Alex Steele. I want to take a look at gold. Let's take a longer-term look at gold because the intraday chart is going to show you a little rise to 24.96. 2,500 is the level that it hit just a few minutes ago. And here's a one-year chart. This shows the incredible climb that we've seen in gold at a time when, especially in the last half of the year, when Bitcoin really didn't help during the Manic Monday, flash crash. Gold continued to remain steady.
There's your hedge right there.
Coming up in the next hour, Ann Sonders joins us of Charles Schwab. We're also going to talk to Evite CEO Ann Defoe. Stick with us on Open Interest. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak is off today. And coming up on this program, stocks on course for their best week this year, but a weak reading on the housing market derailing that rally today. We'll get consumer sentiment data in just a few moments. And caution from Austin Goolsbee. The Chicago Fed president says that the labor market and some leading indicators on the economy starting to flash some warning signs. And Kamala Harris will unveil her economic proposals at a rally in North Carolina today. We've got the details on her eco agenda, Matt.
Let's get a check on what the markets are doing today. We saw the look for the week. They're still up 3.5% for the week, at least the S&P is, but unchanged right now. And this data that you see at the bottom of your screen has the potential to change. Any economic data point has the potential to change the direction of the markets these days. It's breaking. You see it there. University of Michigan sentiment a little bit better than expected out of consumers, 67.8. We were looking for 66.9. Current conditions, a little bit worse, 60.9. We were looking for 63.1. And then the inflation expectations, which I find interesting, a little bit higher 1 year, 2.9%, and 5 to 10 years, 3%. We're looking for 2.8 and 2.9% respectively. So,
all right.
Let's wrap our heads around this data. How shall we do that, Katie?
Let's do it with Mike McKee, of course. He is our Chief International Economics and Policy Correspondent. He's sitting right to my left before, of course, he goes to Jackson Hole next week. What do you make of these numbers?
They're pretty much in line with what we have seen. Now, the interesting question about the numbers and the current conditions index is that the previous Michigan survey did not capture the change from Biden to Harris. And there's been a lot of talk about people feeling better with Biden out of the race, and it doesn't seem to have affected people's views of the current economy, although we do see a rise in expectations. Whether that's related to the politics or not, hard to tell. For the Fed, no change in the inflation expectations. That's good news, just fits into the narrative that they can continue moving towards rate cuts.
They've been winning the big game lately against Ohio State, but Mike Wilson kind of poo-pooed the data, saying, it's inversely correlated to inflation. So he didn't seem to really care that much about it. How important is this to the Fed?
Well, the inflation expectations data is important to the Fed, along with what you get in the markets when you're looking at the various inflation measures, tips or swaps or whatever, because they want to make sure that inflation doesn't get ingrained. And the idea is that if people expect inflation to be higher, it will get higher because they will take actions to try to make more money or do something to offset that. So they keep an eye on it. It's been tame, and they've taken credit for keeping expectations in check, which they believe is because of their credibility on inflation. People believe they would raise interest rates, which they did. So they're relatively happy with this. In terms of the overall sentiment numbers, they don't bear a lot of relation to what people are going to do in terms of spending. Alan Greenspan's famous line, we watch what they do, not what they say.
Right, that's an important one there. The S&P 500, though, erasing declines right now. We're back to unchanged. Before we let you go, I do want to talk about Jackson Hole. Of course, all the central bankers gathering in Western America, in the mountains. They always tend to make news out there. What might the headlines from this year's Jackson Hole meeting be?
I think they're going to be relatively tame. Jay Powell's going to get all the attention for his Friday speech, but when you think about what he can say, it's probably going to be, we've had more inflation data that is good news and keeps us on track, and maybe at some point soon we can start cutting interest rates. But he doesn't want to lock that in because there is still data to come, another CPI, a jobs report, et cetera. And then all the other Fed officials out there who are talking, and not all of them do, but they will probably say much the same. Austin Goolsbee seems to be now trying to set people up for maybe a dovish move in September. In other words, they cut rates, but they don't promise to cut rates again right away, or they do promise to cut rates again right away because he thinks they're going to need it. But beyond that, I don't think you get a whole lot out of it. I know Bill Dudley had a column today suggesting Jay Powell might talk about the framework review, but that doesn't start until the fall, so I don't think he'll front run.
One thing I want to get out of it is I know that the surveillance is going to Jackson Hole, right? I want to see John Farrow in a cowboy hat and boots at the $1 Million Cowboy Bar. Can you make it happen?
I think John is staying here. I think it's just Tom and Lisa that are going.
Tom and Lisa that are going. And last year, Tom went to the $1 Million Cowboy Bar in his suit and bow tie.
He looked amazing.
Let's put it this way. Nobody was confused about who Tom Keene was in that bar.
I'm sure he's a celebrity there. Michael McKee, thanks very much for joining us. Be sure to tune in to Bloomberg for special coverage from Jackson Hole. Fed Chair Jerome Powell will speak on the U.S. economic outlook next Friday. We will bring you that live. Unfortunately, no Pharaoh in a cowboy hat. We're joined now by Ann Sonders, Charles Schwab, Chief Investment Strategist. Ann, it's been a pretty crazy couple of weeks here after the non-farm payrolls miss and then the Manic Monday. We've been, for the most part, off to the races because I guess we're no longer scared on the growth side anymore. What's your take on these markets?
Yeah, I think for now we did move into a mode of good news is good news. And you're right, it was in the aftermath of the non-farm payrolls report. And I think that's increasingly important in the labor market because the Fed has essentially told us that they haven't put the inflation data in the rearview mirror, but the labor market data is coming into sharper focus. And I think decision making around when they start, which is likely to be September, how aggressively they move, will be at least as much driven by what goes on in the labor market as what we're seeing in the inflation data. So, but I also think, as we've seen on a day like today, where you've got weaker housing data versus yesterday, where we had stronger retail sales data, is we are still dealing with cross currents in the economy. This is not a straight line in either direction. And when we start to cheer that, okay, the news is Goldilocks, like, you kind of get hit with something in the opposite direction.
And is that really the laser focus of this market right now, what's going on in the economy? Because we have all these earnings, we talk about them ad nauseum, and it seems like, at least at the index level, it's really the economic data that is just driving all the movement right now.
It is the economic data because of elevated concerns about recession. I think that was exacerbated through a couple of things. Frog in the throat. Number one, you had the fund manager survey come out from B of A suggesting that fund managers now have recession as their greatest concern. You had the intraday move in the yield curve back into positive territory. A lot of people think that it's the inversion of the yield curve that is kind of the recession warning. That's more the recession watch, and the uninversion is the recession warning. Now, it was only intraday, and it came back down again. But you add that to the weaker jobs report, I think the economy is in sharper focus. And as it relates to earnings, second quarter was stronger than expected right now, running on a blended rate at about 12 or 13%. But throughout the reporting of second quarter, we were seeing a diminution to expectations for the third quarter, and expectations now are for a growth rate about half of that. And you add in the concerns about the cost side versus revenue side of AI, and I think we're likely to see some more bouts of volatility, including some periods of calm.
Yeah, so second quarter earnings, it feels like they were good enough that we could basically ignore them.
They were great.
They were okay.
12 or 13%?
They were pretty
The
mixed.
end of an earnings recession for the rest of the S&P?
Yeah, but as we were talking about with Linda Duessel, maybe the inflection point there, you think about third quarter estimates, and that's where I want to go, Ann. They're starting to come down, even though we're really focused on the economy right now. If we did start to see a deterioration in the earnings picture, I mean, would that take over as being the zeitgeist?
Yeah, probably. We did through the corrective phase, which didn't quite get there on the S&P. We did on the NASDAQ and up the cap spectrum into areas like the Magnificent Seven. You were more in the 15% drawdown during the recent pullback phase. That didn't do a heck of a lot to ease some of the valuation concerns. And the hope, of course, has been, especially in light of stronger than expected second quarter earnings, that you would see earnings play catch up to what has happened to valuations. Now, valuations have come down a nudge, but now we have that rolling over and a bit of deterioration, not into negative territory for the third quarter. But that narrative has changed a little bit because we're not going to see earnings catch up to some of that valuation expansion as quickly as many would have hoped.
Before last week, we were so focused on the presidential election as it relates to markets. It seems like the idea of a Trump trade or the importance of that has flown out the window. How focused are you? How focused are your clients on, November?
They're focused on it just in terms of the amount of uncertainty. What we're hearing a lot is concerns about a close and/or contested election and what that would mean for volatility in the post-election period of time. One of the things that we always cautious investors around is not to try to trade the market based on potential election outcomes. It certainly happens. There's a lot of trading that gets done in terms of sectors that might be seen as beneficiaries or get hurt by policy, but there's not yet been a lot of policy discussion. So I'm not sure that's such a big driver at this point, but I think it is a sort of a fool's errand to try to play the trading a game leading into an election, especially in advance of knowing whether we're likely to have a divided Congress, what the majorities will be, because what gets discussed on the campaign trail and what could actually be implemented, there can be a yawning gap between those two, obviously.
Yeah, and of course, it's anyone's guess to see what actually happens in November if you take a look at the polling. I do want to talk to you a little bit about the carry trade before we let you go. We've been debating how much it actually matters. And from your standpoint, where you're sitting now, what's your view, whether or not we're done with the bulk of the unwind? And even if we aren't, what are the long-term implications of that?
So, it's hard to assess what portion of the yen carry trade has been unwound. I suppose JP Morgan is as good a source as any, and it was, I believe, last Thursday when they came out and said it was probably 3/4 of the way unwound, and that provided significant support for the market. You saw that, ripper of a rally. My colleague Jeff Kleintop, who is our international strategist, thinks that, that's probably around in line, meaning essentially the majority of it has been unwound. But you could see carry trades get put on again, and then you've had the ripple effects, because when you look at correlations and you look at the last week's unwind of the carry trade and the commensurate hit to areas like the Magnificent Seven, it's easy to infer that a lot of that money via the yen carry trade went into some of those high beta, mega cap, tech, AI kind of areas. We just think that any additional volatility associated with the yen carry trade might not be as disruptive as like what we saw last Monday, where you had, a lot of people don't realize that in terms of the VIX, you had the largest ever intraday surge in the VIX. That same day, you had the largest ever intraday decline in the VIX, all in one day. By the end of the week, it was sort of ho-hum. If you were only looking on a weekly basis, it was sort of a nothing to see here, but the intraday swings were wild. We don't think that kind of action is likely in the near term.
Yeah, a lot of fun, but pretty wild, I guess, if you're actually trading it. Charles Schwab, Chief Investment Strategist, Ann Sonders, great to speak with you. Meanwhile, you take a look at these markets right now. The S&P 500 back to flat. Their small caps up about 0.5%. Let's take a look at what's moving underneath the surface right now with Abigail Doolittle.
And quite a bit is moving beneath the surface. Let's start off with some analyst moves, starting off with the shares of 21st Century Fox, up 1.8%. This as Wells Fargo has double upgraded the stock from underperform to outperform, basically on sports streaming, saying that this is really a big opportunity, that even potentially it could just move right into ESPN investors liking this analysis. Nike up about 0.8%. Williams Trading upgraded the shares to a buy from a sell, so a pretty strong call there as well. They like the recent rehire of Tom Petty as head of U.S. wholesale. In the last quarter, there was a lot of negative information about inventory basically stuck in the channels. So apparently Williams Trading believes that Tom Petty will be able to take care of that issue. And that stock has been under pressure on the year. Last time I looked, down more than 20%. But today it is higher. As for what's helping out from the big point standpoint, Tesla up 2.4%, back above its 50-day moving average. I would say some technical buying there. It's not clear if it'll stay above there. Alphabet trying to move above, I think it is, or bounce off of its 100-day moving average, so more technical trading. And Netflix up a healthy 1.3%. On the downside, however, we do have Microsoft trading lower, and in some of those 13Fs that did come out, that Leon Cooperman has slashed his Microsoft holding. The stock right now down about 0.6%. Meta Platforms down more, down 1.5%. And then, of course, on earnings, we have Applied Materials, the semi-cap equipment company, so the machinery that makes chips. This stock is down. Interestingly, Matt, the quarter was fine, the guidance was fine, but the guidance underwhelmed because it was only in line. Investors wanted more on AI demand. They didn't get it, and the stock is down by nearly 3%.
Tom Petty. I miss that guy. You like Tom Petty?
I don't think it's that Tom Petty. It's Tom Petty, P-E-D-D-I.
No, I know it's a different one, but the other one is the one I know. I'm sure this Tom Petty is also
great guy.
A fantastic operator.
Probably.
Probably not as good a musician, songwriter.
Few are.
Yeah. All right, coming up, Kamala Harris makes her economic policy pitch to voters today, including subsidies for first-time home buyers as much as $25,000, parents as much as $6,000 for a newborn, and low-income Americans. This is Bloomberg. Let's get now to high interest, look at what's making headlines around the world. JetBlue's third biggest shareholder isn't an institutional investor or an activist or even a famous meme trader. He's just a regular guy trying to make a buck. One man's expensive side hobby is quietly building a stake in the money-losing airline. His 8.1% of the company is worth $132 million, roughly on par with Carl Icahn's stake. It's a great story on the Bloomberg terminal. I recommend you check it out. Republican nominee Donald Trump isn't pulling any punches in his race for the White House. Here's what he had to say on his strategy of personal insults against Vice President Kamala Harris.
As far as the personal attacks, I'm very angry at her that she'd weaponized the justice system against me and other people. Very angry at her. I think I'm entitled to personal attacks. I don't have a lot of respect for her.
Staying on the Trump campaign, in addition to the return of Corey Lewandowski and Dan Murtaugh, the former president has picked the leaders of his transition, Linda McMahon of World Wrestling Federation fame and Howard Lutnick of Cantor Fitzgerald will co-chair Trump's transition team should he win his bid to return to the White House. Here's what Lutnick said about Trump's campaign on our show last month.
He needs money, right? It's a race now. It's a hot race now. And, Donald Trump needs the fundraising, and I'm trying to help every way I can.
And on the campaign trail today, Kamala Harris will lay out her economic agenda in North Carolina. It includes federal subsidies for parents, home buyers, low-income Americans, as well as new programs to curb increases in rent and grocery prices. Let's discuss all of it with Bloomberg's chief political correspondent, Anne-Marie Hord-Dern. And we've been asking for details on what her policies might actually look like, what that portfolio could be. And less than 3 months ago, we're starting to get it.
Right, but we're just getting the top line. So I think what you're not going to see from this campaign just yet is actually the details on how some of this would actually come to fruition, especially when you talk about big subsidies that would require going into the tax code and editing the tax code. You need congressional approval. You cannot just do this unilaterally from the White House. But what it does say, and it's a clear message, is that she has the high cost of living in mind. This campaign, before they even go into the DNC, a really big, important political message they are sending is, we actually hear you. We understand high cost of living is a huge problem for you, and you're unhappy with the current economic status. So basically what they're doing is they have this idea about price gouging, which a lot of economists have basically rolled their eyes about, but it's getting a message to the American voter that we understand your grocery bills may be too high. We understand that you can't get on the property ladder with this $25,000 subsidy for first-time buyers, and then, of course, the expense of having children, the child tax credit. That's something that actually may have bipartisan support, though, because we also heard Ohio Senator and VP pick for Donald Trump, J.D. Vance, talk about.
Yeah, she wants to raise it to $3,600 per child, $6,000 if it's a newborn. I think Vance wants to raise it even higher. $5,000. The interesting thing is, so on the one hand, she's taking a lot of platforms from Donald Trump's, planks from Donald Trump's platform, right?
It's a populist message on both sides.
Exactly. But Trump isn't taking advantage of, Biden's failure, if you will, on the economy. He would rather just insult Kamala Harris, as we just heard in that SOT. Why isn't he listening to what his advisors must be telling him?
Well, his advisors are trying to tell him this. And I think yesterday you saw this clearly. They even placed groceries that consumers buy, Folgers coffee, cereals, all behind him. And he struggled to stay on message and on script. And instead, he took some moments to go after Kamala Harris, when what the campaign wants him to do is, look, Americans are still feeling inflation. Yes, the rate of inflation is coming down, but they've struggled to explain that even though the rate is coming down, what Americans are feeling is that prices haven't come down. Just they're not accelerating as fast. And what the Trump campaign wants him to do is attach Kamala Harris to that feeling that people are feeling right now, because it's not just Biden. She was the vice president for the past 4 years.
Yeah,
she
and
has
it's not just a feeling. Prices are very high. Like when we got the inflation numbers, even though they were better than expected, the message should be, hey, prices are still rising.
The level matters here. I mean, that's what people feel at the grocery store. We only have 30 seconds left with you, but of course you're headed to the DNC next week. There's some story on the terminals about cops vowing to really fend off havoc should there be
protests
protesters.
are going to be amazing.
Yeah, what are you expecting on the ground?
Well, this is what a lot of people in the Democratic Party were fearing. Is it's going to be a repeat of 1968? There are going to be protests. Protests have followed Kamala Harris and Biden across the country during their rallies, so you can expect them at the DNC.
They're fearing that it could be a repeat of 1968. And so they picked Chicago for the convention.
I think Chicago was picked before this.
All right, Anne-Marie Horton, we'll look forward to your coverage next week. She will be heading out there to the Democratic National Convention, and you can catch her every morning co-anchoring Bloomberg Surveillance as well. Still ahead, Rivian tapping the brakes on its Amazon delivery vans. We'll tell you why in today's Social Climbers. This is Bloomberg.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, BioNTech falling after the vaccine maker announced that its vaccine candidate for the flu and COVID-19 that it was, of course, jointly developing with Pfizer, it missed on one of its two main goals in a late-stage study. Next up, another roadblock for Rivian. The EV maker is pausing production of the electric commercial vans it makes for Amazon thanks to a parts shortage at its factory in Illinois. Rivian said it expects to recover all missed production, but provided no timeline. And finally, Bryant Riley, the co-founder and largest shareholder of B. Riley Financial, is informally offering to buy the shares of the embattled investment firm that he doesn't already own. Riley is willing to buy the stock at $7 a share, according to a regulatory filing. And of course, you can follow all the latest company buzz on TRE and Go on your Bloomberg terminal, Matt.
All right, let's get a check at what's going on in the markets right now. We are about an hour into the trade, and the S&P 500 is flat. The NASDAQ down about 0.1%, but also moving closer and closer to unchanged. Coming up, online invitations innovator Evite is enjoying a 50% revenue jump year over year, but they have stiff competition. And will they ever go public? We'll talk to the CEO, president, I should say, and a foe next. This is Bloomberg. Since joining Evite 2 years ago, Ann Sonders has been on a mission to modernize the world's first online invitation platform. She's since taken over as the company's first female president, and business is booming. Evite has seen a 50% year-over-year revenue jump as it looks to stay ahead of its competition. And Ann Sonders joins us now to talk about this growth story. Thanks so much for your time. Is the industry in general just picking up? Do we no longer send paper invites?
There's definitely been a definitive shift where a lot of people are switching over to digital. It's a new way to actually invite people to your party. And even beyond that, since the pandemic, what we've really seen is there's a shift in how America feels about get-togethers overall. People now value in-person events. They value community more than ever before. And a good sign is, this past graduation season, we've seen the highest number of graduation events in our history. People want to celebrate these milestones. Another trend that we're seeing across America, millennials and Gen Zs, they're turning these low-key get-togethers into thematic events. Some trending themes are Taylor Swift, no surprise. Summerween is another trending theme. But what this is telling us is that people not only want to celebrate milestones, but they want to make these casual get-togethers even more special, which means great business for Evite.
And I mean, you think about the competitive landscape. There's Evite, there's paperless posts. Those are the two big ones that come to mind. I mean, how do you compete? What do you offer, for example, at Evite that paperless post doesn't? How do you differentiate?
I think that's a very good question. Evite, we started with invitations. A lot of these competitors are in our invitation space, but we're thinking beyond that. It's the reason why we actually built a brand new tool. And this brand new tool is live on our site right now. It's called Evite Sign Up Sheets. If you had an event that's catered around, say, potlucks, and you need people to sign up and bring an item, this is the tool for you. Right now, school is starting all across America, and a lot of teachers need parents to volunteer for their classrooms. This is the tool built for them. It's live on our site. It's the fastest tool on the market to actually get your sign-up sheet done. You could get it done in seconds, and it's absolutely free. And this is the way that we're starting to differentiate ourselves from our competitors, because we're building multiple products to actually help the community get together. We're building an ecosystem, a one-stop shop for all your planning needs. That's our biggest differentiator.
You know, a company like yours, I would have said a few years ago, prime candidate for an IPO. Is that on the books? Is that not a great way to raise money anymore?
You know, we never say never. I think that's a great question. But right now, we are heads down focused, and we're doing so well on serving our audience and our hosts and our community needs. America is partying right now, and, you know, we're just trying to help America party. So as long as we stay focused and build a really durable business, I think we let this journey take us where we need to go.
And I mean, how do you scale up here? I know that Matt doesn't think that mergers exist. He likes to focus on acquisitions. Would you ever consider one of those, for example, either being bought or buying another company to kind of scale up here and grow even further?
Yeah, I think that's a good question. We consider all options. At the moment, we never say no to anything. However, I think we just have so much opportunity to help our hosts and build this ecosystem that we are heads down focused to help our users. And, you know, one motto that we have around our company, how can we always be helpful to hosts? And if we keep that in mind, I think all the right things and the right answers will follow.
Paperless Post, I guess, is your biggest, I think the only competitor that I can think of. Is this essentially a duopoly? Do the two of you fight it out for total supremacy?
Good question. But I think Paperless Post is in a, I think, slightly different strategic position than we are. We are still by far the largest online digital invitation. We are America's digital invitation company. We watch all of our competitors, Paperless Post, including, you know, other competitors out there that are emerging. Of course we do, and we take interest in it. But we are by far the most dominant player out there, and we're building our own strategy like this ecosystem to solve host needs. So we feel very strongly where we're headed and where we're going, and with that, we will remain the leader in this space.
When you're raising money, and I just wonder what it's like to be a woman in this business. I know the company was very happy to get you in there, and, you know, startups just have trouble attracting VC cash. I think less than 2% of VC money goes to female-founded companies. What's it like, you know, in this growing tech business on the West Coast that has a kind of bro-y reputation?
I think, I mean, of course, I can't say it's completely easy. It's definitely tougher for women out there. But I think in more recent years, there's definitely been more support overall. And I think what's really, really helpful in this particular space, too, our core demographics are moms. I'm a mom myself, so I think I have a competitive advantage in particular for this particular company. But overall, it's tough, but you weather through it, and then you prove what you're capable of doing. And I think I have proven by leading this company to where it is and the growth that we've seen that, you know, we could hold our ground.
All right, Anna, really appreciate you taking the time on this Friday morning. That, of course, is Ann Defoe of Evite. Let's get a check on these markets, of course, a little bit over an hour into the cash trading session. We're going to do that with Abigail Doolittle.
And stocks on the day, or at least the S&P 500, sort of wobbling between gains and losses. On the week, though, we have a really healthy gain for the S&P 500, up more than 3.6%, heading to its best week since November of 2023. What's interesting, though, if we take a look at this one-week board, these different asset classes, it's a mixed picture because we have oil. That's a risk asset, a signal on the economy. It's down 0.8%, so not confirming the gains that we're seeing in stocks. The 20-year yield down, that tells us bonds are rallying, at least the 10-year out is rallying. And that also speaks to a bit of a haven bid. So again, not really supporting the move higher for stocks if you think about things in an upside, or excuse me, a right side world, not upside down as it is in terms of thinking about it around the Fed. And then interestingly, the dollar yen, after all of that big movement, this is one reason that we do have stocks higher, because that carry trade unwind, if there's more to it, there is reason to think that could be the case, certainly on pause. Now, if we bring Bitcoin into the picture, this is really very interesting. Bitcoin over the last 3 weeks down. This, of course, is a show more focused on stocks. So let's take a look at it, a proxy for it. Coinbase Global, over the last 15 days, down 16.3%. If you think about Bitcoin and the crypto space as the new VIX in terms of a risk-on, risk-off signal, this is risk-off. So when you put all of this together, I would say that there's probably more volatility ahead. Volatility breeds volatility. Last hour was promising an NVIDIA chart, an update there. Let's take a look at NVIDIA, and I actually even forget what I put together. Well, these are the sectors on the week, and you can see the big outperformance for tech. Now let's take a look at that NVIDIA chart. You can see all sectors are higher, but NVIDIA right now, even though we've had this massive recovery to the upside, this is a daily chart, and what we're looking at is these trend lines, as I was mentioning. It's not to see the trend, it's to see the reversal. So the primary uptrend out of the 2023 lows has started to reverse. The secondary uptrend, it is being caught right now in between. The RSI is sort of in between overbought and oversold. Overall, Katie, typically this will be a reversal on 3 trends. So we see the shares weakening, even despite the massive rally this week into earnings on, I think, August 28th. Stay tuned. There could be some more volatility ahead for NVIDIA, where maybe for 1 quarter out of the last, 4 or 5, it's not the absolute blowout. Even very good from them could be disappointing. That may be what this chart is pointing to.
You know, back in July, Abigail, you were looking at the technicals. You told us NVIDIA shares were likely to go below 100, and I note they did actually close below 100 on Wednesday. I mean, intraday they dropped on a couple of different sessions. But what's the price action look like to you going forward? Well,
So that speaks to this reversal. So that primary uptrend reversed onto that low all the way down to 90. Now you have sort of Newton's third law, that equal and opposite reaction, back higher, some of the dip buying. However, we're hitting the resistance of that primary uptrend. Unless the buyers can really take it back above, let's call it, 130 or so in a very convincing way, it suggests we're going to go back down toward the secondary uptrend, which is also below 100. There is a chance you could go higher and then below, but the bottom line is once you start to see an uptrend reverse like this, and again, it typically happens in 3 waves, it points to more selling ahead, which will be well below 100 at some point. That might not be on this earnings report, maybe early later this year or early next year, but this uptrend is certainly starting to weaken.
Well, you're right in that NVIDIA does report on August 28th after the bell. So obviously a crucial one if you take a look at the charts as well. Bloomberg's Abigail Doolittle, thank you so much. Now coming up, traditional media struggles to keep up with the big tech players. Former CNN President Jon Klein tells us why it's an industry-wide problem next. This is Bloomberg. Time for our Wall Street Week conversation, and it's been a tough time for media companies. Paramount started the week announcing a fresh round of layoffs and ended the week as the possible target of a bidding war. David Weston asked Jon Klein, the former CNN president, about the recent drama in the media space.
It's a problem with the industry that they find themselves in, is what it is. And this goes way beyond just Warner Brothers Discovery. So, in their case, they've got to swim in the same waters as every legacy media company. They've got a lot of brands. They've got a lot of assets. The main driver of their profit has been the cable TV networks, TNT, TBS, CNN, et cetera. and just the raw amount of revenue available to cable TV-driven businesses has shrunk considerably. The other component of their business, the studio business, same thing. Just the pool of money available for them and all of their competitors to make has shrunk. Subscriber fees that the cable distributors are paying have shrunk because viewers have left. So your monthly income on a per subscriber basis has plummeted. And as a result, also, advertising revenues have plummeted. And so, of course, you've got to retrench. You've got to make cuts. They're all doing it. You mentioned Paramount just began their wave of layoffs, their latest wave of layoffs today. And even Axios, which is a digital-only business, they've been through their biggest layoff in the past couple of weeks. So in general, media is really coming to terms with the reality that it's more than ever an industry dominated by the tech giants, the Apples and the Amazons, and certainly Google, which owns YouTube, which is a monster. The industry is dominated by those players, and there's just less opportunity for content creators.
So what do you do in that environment if you're running one of these big media companies? I mean, I think both of our experiences, it's awfully hard to cut yourself to success. You may have to cut, but it's hard to get to success by cutting. Often you then start to think about deals, and John Malone, after all, is the force behind the throne there at Warner Discovery. Are there deals that could be done, consolidation deals, that might make things better?
Well, you're going to probably look to your left and your right to see who's in the same boat. I think that was their original strategy at Discovery when they did the acquisition of Warner Media, was to get big enough that they could maybe be the biggest kid on the block and dictate the terms of other acquisitions and start doing roll-ups of other players. Now they're not the biggest kid on the block. Now their market cap has taken such a severe hit that the deal numbers themselves are going to be much smaller, but that's what's going to happen is consolidation for all of these guys. You know, you have a new team coming into Paramount, David Ellison and Jeff Shell, who's so sharp. They at least have the benefit of beginner's mind. That is, they can look at that Paramount portfolio of companies in a fresh way, and they also don't have the legacy relationships inside the company, and they can maybe make some tougher decisions. But it's tricky moving forward. Warner Brothers Discovery is going to have to find consolidation partners, merger partners, and just last month in Sun Valley at the big media conference, you know, David Zaslav was bemoaning the excessive government regulation in his mind, you know, that prevents them from making mergers too easily.
So it's one thing to get bigger. People like to get bigger. What about also getting smaller in this respect? Netflix has done pretty well for itself with basically, if I can put it this way, a movie studio hooked onto a streaming service without all those pesky linear channels that you and I have worked with through the year. Is that a strategy? You say, let's double down on the production and the streaming, and let's get rid of the businesses or do something about the business that aren't going anywhere. They're not growing.
Netflix has had the advantage always of being a tech-first company that applied that technology to media content and distribution. At first, just distribution, and now they're in the content business as well. And their market cap is what, 20 times that of Warner Brothers Discovery at this point, and so they've got that inherent advantage. The problem is that everything we're seeing today is the result of the impact of technology on content distribution.
That was former CNN President Jon Klein. Wall Street Week's David Weston joins us now at the desk. And, of course, you are also the president of ABC News. You have some experience in this sector. I thought it was interesting that he mentioned David Ellison and Paramount. They have a job ahead of them because now we have learned that Edgar Bronfman Jr. may put in a bid for those Paramount assets as well. What do we know about this business?
Well, what I know about that specifically is that there's a go shop provision. Actually, they had to go out and take other offers for Paramount, and the special committee is taking a look at those offers right now. And now, as you say, Edgar Bronfman has come in. He's been in this business before. So obviously the board has to go through carefully and review this as a fiduciary about what the best deal is. So we'll see where it all ends up. As I say, Edgar Bronfman has been in this business before, but also David Ellison has a pretty good reputation, at least as a movie producer.
I mean, this is just the deal that won't end. How long have we been tracking every sort of turn here? And at this point, what are they fighting over? When you think about the fundamentals of the business, I mean, Paramount began this week announcing it would cut 2,000 U.S. jobs. It reported a second quarter loss after writing down the value of its TV networks by $6 billion. I mean, this is a really struggling business in a struggling, difficult industry.
Yeah, by the way, Warner Brothers Discovery also wrote down the value of their linear channels because they're recognizing what Jon Klein was just talking about, which is they just are not worth what they were paid for originally. You've seen this in the media business before, maybe not this dramatically, where there's a cost structure built up for a certain revenue stream. The revenue stream shifts, and all of a sudden you got to cut the cost structure. I mean, broadcast had this with cable because they built up a really big cost structure, and cable came along, started competing away some of the advertising revenue, as well as adding subscription revenues. They had to cut the heck out of the cost structure. And by the way, I had to do some of that myself.
I'm sure it was unpleasant, as it must be for Zaslav as well.
Yeah.
Who are, the takeover prospects? Who's going to get together with these companies?
I think there are two questions there. One is, do they get together? I mean, I wouldn't be surprised to see a John Malone, for example, try to do something with Paramount and try to put together the streaming services of now called Max, giving up the HBO. I'm not sure about that, but giving up that and making it a Max.
Giving up the most important brand in media.
Yeah, certainly one of the most valuable. That's exactly right. But anyway, you could put some consolidation, but you have to think carefully. How often in history have you taken two weak businesses and put them together and made a strong business? That's usually not the way it works. I think the bigger question that Jon Klein was pointing out that I find very interesting is it really all up to the tech giants at this point? Is it all up to Googles and the Amazons? Because they have all the data, they also have other ways to make money. And so you leave the legacy media companies really going almost hat in hand to say, please help us out here some. And so, listen, the most successful media brand right now probably is YouTube.
Yeah, there you have it.
Right.
David, we have to leave it there.
Yep.
It is great to see you. That, of course, is David West. And, of course, tune into Wall Street Week tonight at 6 p.m. New York time. This is Bloomberg. Well, leveraged single stock ETFs have boomed in popularity this year, and Defiance, a $1.4 billion asset manager, may have launched the most volatile fund yet in the U.S. Joining us now is James Seyffart of Bloomberg Intelligence. And of course, we're talking about 1.75 leverage of MicroStrategy, which is already kind of a leverage bet on Bitcoin. And I know that the Bloomberg Intelligence view is that these are trading tools. They aren't supposed to be held long term. But how much confidence do you have that people actually are treating them as they're supposed to be treated?
Yeah, so the benefit is we can see how much these things are trading, and they're trading a ton. So there's no way to know if there's some people out there that are just holding this long term. But for the most part, these single stock ETFs, they're being largely used that they're supposed to. But it's over a $30 billion industry right now, and these things charge a lot of money. So it's good for these issuers.
Where are you seeing the flow? The flow's been telling us this week, James. I've always found that's one of the most interesting and important functions of ETF Go on the Bloomberg.
Yeah, I mean, right now, the money is, well, specifically with these single stock ETFs, the flows are going to these really high volatile names like MicroStrategy, names like NVIDIA. There's one NVIDIA fund, NVDL, it's over $5 billion, and that is the number one leveraged single stock ETF out there. But essentially, it's anything that has a lot of trading, a lot of controversy, Tesla, you name it, things like that. Those are the names that are going to get a lot of the flows.
All right, James Seyffart, really appreciate your time. That, of course, James Seyffart of Bloomberg Intelligence. And because of special coverage of the DNC next week, ETF IQ taking a break, but you can catch me the Monday after, the 26th, 12 p.m. Eastern. It's a great show, Matt. I don't know if you've ever watched ETF IQ.
In fact, I have co-anchored that show for quite a long time,
Yeah.
but I'm happy to leave that duty now to you, Scarlett Fu and Eric Balchunas, and I watch it every Monday.
As you should. Best 30 minutes of Bloomberg TV. Let's take a check of markets right now. Of course, the end to the week. You can see the S&P 500 down about 0.2%. The NASDAQ 100 down 0.3%. The bond market just about flat. Of course, whipsawing today as we get that back and forth data, Matt.
All right, coming up next week on Open Interest, join us in the C-suite where we will be joined by the Lifetime Fitness CEO on Monday as they announce the perfect new pickleball. Then Edbridge CEO Greg Abel on Tuesday. This is Bloomberg.